It's April 27th, 2009. Steven Swancoat here with GannScience.com, and we're going to be looking at a one-year chart of Apple and how to do the basic technical analysis of it using the trading methods of W.D. Gann, Jesse Livermore, and a little bit of the Elliott wave theory. Like I said, we're looking at a one-year chart of Apple. This is a line chart. I prefer to do all my technical analysis on basic line charts. I don't use any charting software or charting programs. And I do not use candlesticks. I feel that candlesticks offer a lot of false signals, and a line chart really lets you see exactly how that stock is acting. So to begin with, Apple topped in 2008 at 202. I traded it in for the big bull market of 2008 and sold out my shares, taking a nice profit. But have since had my eye on it and watching it for potential breakthrough to pick it back up again if there's a new change in trend. So here we go, we're looking at it, and in late October 2008, it fell all the way down to about 90. After this huge major crash that it had from 185, 190, then proceeded to rally all the way back up to 110 before falling all the way back down to a little bit over 80. Right now, this is a clearly defined downtrend by the rules of W.D. Gann and Livermore, saying that a downtrend is a trend that's making lower highs and lower lows, and an uptrend is making higher highs and higher lows. It sounds very simple, but so many traders make mistakes by trading against the trend. I cannot stress that enough. The trend is your friend. Looking at this chart right now, here in early December, or late November, early December, it made a bottom at a little bit above 80 and proceeded to rally all the way up to 100. And what we're looking at here is this top right here at 100. This is very significant as it marks, once again, a lower high, thus showing that Apple's still in a downtrend. However, the importance of this is that it did not break through 100. Both W.D. Gann and Jesse Livermore distinctly said, W.D. Gann in the Wall Street Stock Selector, his stock course, and Truth of the Stock tape, and Livermore, in Reminiscence of a Stock Operator, said that whenever a stock is going to break through a large number, a psychological number like 100, 200, 300, it almost always breaks through with speed if it's going to break through. If it doesn't, it'll show a lot of resistance right around that large number. W.D. Gann also had the rule of 3. He said that if a stock was going to break through a major barrier, the 100, 200, 300 mark, it was always safe to buy if it broke through by at least 3 points, and then always set your stop loss 3 points under that. So in this instance, if this stock was going to proceed to go through, you'd want to buy it at least at a minimum of 103, 104, 105, and then you can set a safe stop loss at 98, 97, and you'd be picking it up in a perfect position because you'd be in the beginning of a major change in trend or bull market, or you're going to invest a little bit and possibly at a changing time and have conflicting signals, and it's a downtrend, and then you've cut your losses short. So right here, this is clearly seen that it does not break through 100 and proceeds to actually crash down all the way past 80, making an even lower low. Then in late or mid-February 2009, the stock rallied all the way up here and breaking right past 100. And if you actually go and look at the intraday high on that date, it hit $103 and closed below it. So if this stock was going to go through, following the rules of W.D. Gann and Livermore, this stock should have broken through the 103 to 104, 105. You could have easily picked it up and set your stop loss at 97. But once again, this would have been a false signal to pick up because it made an intra high at 103 and then crashed all the way back down to a little bit below 85. However, after almost 6 months, we have this right here, a defined triple bottom. And following the rules of WD Gann, a triple bottom is a significant support, and it's significant in the sense that it will represent major support. However, if broken, you're looking at a complete change in trend, and that stock is going to fall even farther. And right here, this is indefinite proof of the support of Apple. Now, looking up here in late March 2009, not too long ago, this stock broke through right here. And following the rules of Gann and Livermore, this stock is making higher highs and higher lows. But the importance of this is that it broke this 100 barrier and continued all the way through. It broke through the 103, broke to 105, even hit 110 where it showed resistance right here where my cursor is. And if you go back and look, 110 was the same resistance that was seen here at late October, early November 2008. So it's breaking an old high. And as you can see on this date, it has since blown through, and in a short time has had a nice uptrend. And this right here would have been the window of entry. It still is, in my opinion, for Apple, as there's clear proof that that there's been a support base here at this triple bottom, which took almost 4 to 6 months to completely set up. And then here, with breaking through with higher highs and higher lows, a lot of the public gets duped into thinking that you need to buy low and sell high. Well, the problem is that this bottom right here looks no different than this bottom right there. So the public thinks that they're getting a deal purchasing Apple at 130 because it topped at 202 and it's going through to 300, and they pick it up and to end up in a short month or two to have it fall all the way down to 90, then down to 80. So you need to rely on definite indicators. Next, what we're going to do is, if you remember when I mentioned that rule of Apple, or that Apple topped in 2008 at $202, the Gann student and those following the methods of WD Gann and Livermore would have made a good deal of money because they would have sold their shares at pretty much the high. And the reason why I say that was because if Apple was going to keep on its uptrend, it would have broken through 200 and proceeded to break through 205, 210, 215, all the way through. However, if Apple was not going to break through that 200 barrier, it would have crashed down. That's exactly what it did. So once Apple crossed that 200 barrier, the Gann student, the Livermore student, would have set their stop loss at 197, 195. You could even set it at 193, giving yourself a nice window to allow for the fluctuations. And you would have been hit, and you would have executed an order, and it would have sold out at the top. Now, trying to pick tops is very difficult. And however, in this situation, the top had to be at a nice round number like 200. Now, if you look at Google proceeded to bust through 200, 300, 400, 500, 600, all the way to 700, 747. So in that case, your stops would have never been taken out. I'm running out of time here though, but remember that when you're trading, always make sure you rely on rules, that you have definite indicators to buy. Never buy a stock because it's too low, never sell a stock because it's too high. Always do your own work. I'll be putting out more videos soon, and for more information on the methods of WD Gann, please check out GannScience.com. This is Stephen Swancoat, and thank you very much.